apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets Editor John Dobis. Well, we had some omelet on the face of one of America's most respected CEOs, or at least he was until Thursday night when he divulged that JPMorgan would incur $2 billion in trading losses from its London unit. Not a lot of specifics, but Jamie Dimon, the guy who came through the financial crisis smelling like a rose, is smelling like something not as pleasantly fragrant today in the rough. The London whale, yeah, there's a guy over there, Bruno Ixil, fixed income trader known as the whale for taking outsized positions in his trades. Lately, he had a hankering for CDSs. He was he was trading in CDSs on big corporate bonds, bond indexes. But things went bad. $2 billion in losses, wiped out some gains for a $800 million write-down. It's a lot of egg on his face. This guy in London was also nicknamed Voldemort. Yeah, the Harry Potter guy. Bragged that he could walk on water. I know one guy who can do that, and then there's also Eddie Money, but I didn't know that Voldemort could. In any case, JPMorgan shares were hammered. Just absolutely hammered. More than 200 million shares changed hands on Friday. That's a new record. That's more than in 2008 in November when the world was falling apart. So huge turnover in JPM stock, taking the stock down to its 200-day moving average. Started the week pretty well, up above its 50 and 10, and then kaboom, down to around below $37 per share. JPMorgan does still pay a 3% dividend, and that $2 billion loss on $370 billion in its chief investment office is only 0.5%. You or I probably have that kind of fluctuation in our 401ks every day when the market goes up or down. But with Dimon coming out and being a vocal critic of the Volcker rule, which wanted to limit the kind of trading that banks do, this kind, although Dimon says it was a hedge, but it sure looks like proprietary trading to a lot of people. Volcker doesn't want that going on. Dimon said, you gotta let it go on. Volcker, you don't understand markets. Jamie, you don't understand what's going on in London, bro. So get a handle on that and you'll get your respect back. You did a good job in the crisis. Get back in the saddle, bro. Other bank stocks were hit hard too, pretty much. Morgan Stanley and Citi both off about 4%. Goldman Sachs also. Bank of America didn't take it as poorly, down about 2.5%. Financials, here's the XLF, not totally trashed on Friday, down 1.1%, let's say, as a group. These are all the bank stocks. So it wasn't just an apocalyptic day all around in the financial services sector, but just a lot of shame and humiliation inflicted upon JPMorgan. The overall stock market down a little bit. The SPY down. It started out in the black in the morning. Lost some of those gains in the afternoon. Down about 0.4%. Stocks. The SPY is down below its 50 and 10-day moving averages, but well above its 200-day. So we're still in bull market territory. Here you see the action over the past 3 months. We hit our high in April, and then boom, and then a rally here to in early May. But May's been just one heck of a month. A real bugaboo. So that old adage we were talking about here before, sell in May, go away, the idea that the 6 months of the year between May and October are lousy for stocks, so get lost, there's something to that. But Jim Stack, editor of InvestTech Research out in Whitefish, Montana, smart as a whip guy, put out this in his bulletin, his InvestTech Research bulletin today. Sell in May, not in an election year. Here you see all years, since 1928 to 2011, the monthly return in stocks. And you can see that the May through October period only has one really, really bad month, and that's September. September has just been the killer month for stocks. Now we look over here for only election years, and 63% of election year May through October periods have been positive for stocks. And more than half of those have been gains of more than 5%, and never has there been a drop of more than 10%. And that was actually in the 2008 period, so that was hopefully a once-in-a-lifetime occurrence. Point is, we are in an election year, and election years are usually favorable for stocks. Here's 1, 2, 3, 4, the years of a presidential term. We are currently in the second quarter of the 4th year of President Obama's first term in office. Maybe his last term if Mitt Romney can do anything about it, but maybe he can't. So look at the third quarter. The president wants to juice things. He's leaning on the Fed chairman to stay loose with money. He's passing road to nowhere bills. Maybe we can this year, I don't know. But in any case, folks, this is the history going back to 1928. suggesting that the May through October period isn't that bad in an election year. So don't follow the sheep right over the cliff. Oh, sheep over the cliff. Did I just say that? I meant Muppets. It's time to sell some Facebook to the Muppets. Remember, that was a Goldman Sachs phrase, but we're using it here. People are going to buy the heck out of Facebook stock. You just have a feeling they will. They don't care about the valuation. They don't care about 50 times earnings or 60 times sales. Mark Zuckerberg, he's already out on tour doing the road show in Boston and other cities, trying to drum up interest from the institutional side in Facebook like he needs it. There's a lot of questions, how is Facebook going to grow into its shoes? It's a lot of people looking at Facebook on mobile devices where the ads are really non-existent so far. So there's a lot of questions about it, but so many people know Facebook and just don't give a crap. They'll be buying it. Eduardo Saverin, he knows things. He took some good preparations for the public offering, which is supposed to be next week, probably Friday. Saverin, Brazilian guy who was a Harvard roommate, helped found Facebook. He renounced his U.S. citizenship, which is at an all-time record, by the way. People are renouncing citizenship because the IRS is going aggressively after people all over the world. Anyway, this guy's a fresh billionaire, so he's now a Singapore citizen, and he'll be looking to save some money on his tax bill. Before you jump into the social media networking space, whole hog, look at some of the things that have gone before Facebook. Here you've got Pandora. Great little device. I love it on the iPhone. Don't pay for music. Listen to the crappy ads, but you don't pay for music. In any case, stock is down 55% since its IPO. Not a great return there for shareholders. Zynga, even worse, not worse, but 50% down from its high. It was up at one point, and Groupon has just been a basket case, down 62% since its IPO last November, and all kinds of accusations. And I've never really used Groupon. I don't know if anybody out there has, but it just seems like a losing proposition that you go to a merchant and you spend less than he's usually charging customers, and then you don't come back. What's in it for the merchant? It doesn't seem like a sustainable model, and apparently investors don't like it. One thing that has worked out pretty darn well, LinkedIn, LNKD. I mean, it is kind of the Facebook for professional networking. You get leads, you get job offers sometime, you talk to people, you meet some nuts, freaks, weirdos. But in any case, LinkedIn, look at that, 60 to 120. This sucker's doubled since February. And they might be making some moves with Silver Lake Partners, might be putting up some cash to go after Monster. If Monster and LinkedIn got together, they would have market share in the online job search market greater than the current leader, Career Builder. So go for it, LinkedIn. In any case, don't get too freaked out about all the stock market noise. JPMorgan did take a bunch of egg on the face. We'll see if that egg can be scraped off next week.